Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Welcome, everyone, to today's FIN-LYT by EWA podcast, joined here by Jamison Smith, and we're going to be talking about the impact of taxes on a corporate level and then specifically to individuals and families and how it'll affect their financial plan dependent on the election results. Now, these are just proposals, so obviously, depending on who gets elected, later this year, to pass this stuff, it still has to go through a rigorous process. But we want to compare how you can proactively educate yourself and then make adjustments to your financial plan if necessary. So, Jameson, let's just start with, stock market price earning ratios. These are all driven, the price to earning ratios and profits of corporations all drive stock market. So, some people are, forecasting maybe earnings go down if tax rates go up. So, what's the difference between, Trump and Harris's views on corporate taxes?
Yeah, I guess in general, so I think it's important to know the lay of the tax landscape. So the 2018, what was that thing? The tax, there was some name for
2017.
it. 2017, bottom line, taxes got cut.
Yep.
That's in place till 2026. So after next year, if there's
2017 Tax Cuts and Job Acts.
Yeah, that's what it is.
Job Act.
And so taxes were cut, and if no legislation is changed in 2026, they're going back to the old tax code. But what happened then, corporate taxes were a big thing. I think they went from, what is it now, 21%? I think it went from 28 to 21. So it lowered corporate taxes. And bottom line, Trump wants to maintain that and keep it low. It looks like his proposal is to drop it down to 15 to 20%, or from 21 to 20%. And it says certain companies that make their products in the U.S. as low as 15%. And the difference between Harris's is to revert back to the old tax code of 28%.
Well, the top tax rate before Trump was 35.
Yeah.
We dropped it to 21, and now so originally Biden was saying we're going to go, we want to keep it up. Now Kamala's going to split the difference at 28. So it's still an increase. So Trump at 21. 21 down to 20, and then Kamala's saying 28.
Yeah, and I think it's important to understand, like, in general, there's obviously the national debt is, people talk about it all the time, and so that's basically the premise of any, there's different ways you can increase inflows to the government, and taxes are a very easy way to do so. So that's basically the root of why this is a huge discussion.
Absolutely. And then, so she's also talking about clawing back some of the deductions for depreciation interest for certain rental construction investments, and then proactively wants to expand housing credits, tax credits, including the low-income housing tax credit it's basically a credit for new home buyers or construction of starter homes.
With the corporate tax, we'll just dive into that a little bit. What do you think, what are pros and cons of higher or lower? How does that impact the U.S. companies, U.S. economy, U.S. stock market?
Yeah, I think in a long-term view, we've seen, so if you just look at returns of Democrats versus Republicans over the last 100 years, it's very, very similar returns if you average it all out. And, you get punished if you take your political views into your investment policies, because staying invested, Republican or Democrat, is always the best route. You're going to take your returns way down if you were to just invest when a Republican president or just invest with a Democrat. So history shows us it's irrelevant. I mean, corporations have some of the smartest people that work for them, so they'll navigate higher tax rates. They'll navigate lower tax rates and figure out how to deploy, talent, their cash flows, et cetera. So I think short term, there will probably be overreaction either way. There may be some short-term gains. If Trump were to get elected, if Kamala got elected, with just purely from the tax rates, you can even see this as the polls go. There was a jump earlier this year when Trump was favored, saying, "Oh, tax rates are going to stay down." So the market typically looks 6 months in advance. So long term, I think it's completely irrelevant, and every investor that we work with obviously invested, but there may be some short term noise. But the short term noise would only hurt you or help you if you're making short term bets.
Yeah.
So all of this is totally irrelevant in the grand scheme of a long term financial.
And if
plan.
you're not properly diverse, if you're only in like one, again, this is all speculation, but one consequence could be, okay, maybe you could say if it's high, if rates are higher, U.S. companies will look to do business elsewhere because they're paying more in tax. They go to somewhere that's more tax favorable. But if you're properly diversified and you're not only in the U.S. equities, then theoretically your portfolio should be fine.
Absolutely. Absolutely. Well, let's go through. So, for families and workers, the difference between what Trump and Harris are proposing. So, Jamison, what from an individual perspective, we saw these these tax rate cuts, where we basically have a 10% bracket starting up and then it ends at 37. So he wants to make all of that permanent.
Yeah.
When it expires in 2026. So, let's walk through the differences of Trump versus Harris.
I'm just going to read these off factually, and then we can dive in. So Trump's proposal making expiring income tax rates from 2017 permanent, exactly what you said. Consider replacing personal income taxes with increased tariffs. So again, back to that, how do we replace the revenue? It would be through tariffs, not taxes. Consider expanding the child tax credit to $5,000 universal credit. Reinstate an unlimited itemized deduction for state and local taxes. So that's
big. So right now that's capped at 10,000.
Yeah, as I say, with the 2017 tax cuts, it's capped at 10,000. So if your state and local taxes are 100,000, you only get to deduct 10,000, and that could potentially go away. Exempt Social Security benefits from taxation, exempt tip income from taxation. That's a huge gray area. I've heard a lot of different things on that. I don't know how
it's already not tax. People don't really report their tips anyways.
Yeah, but you could then what's stopping you could pay an employee in a tip and not pay tax. There's so many different loopholes.
There's a lot of loopholes there.
Yeah. Exempt overtime pay from taxation. That one seems like that'd be hard to pass, but
yeah, because that would only affect certain workers, like trade workers and people that are paid hourly, I guess.
So I guess bottom line, it's maintaining the current tax code that's set to expire with a few changes.
Yeah. So this would benefit high income earners the most, right? And purely because you're looking at that top tax rate before of 39.6.
Yeah. Well, that's what it would go back to, right? It's 37
right.
now, yeah.
Versus 37.
Yeah.
So that's if someone's making a couple million, that's 2.6% per million. That's $26,000 of tax savings in your pocket. And again, that 37%, that top tax rate doesn't come in until you're in the 700 range.
Yeah.
Anything above that, but for a really high income earner, that's pretty big. Let's say 3 million above that, that's a 78 grand of tax savings between the two policies. And then the SALT is also big as well because for high income earners, let's say you're making $1 million in Pennsylvania, you'd pay $30,700 in state taxes. Let's say you live downtown, the greater Pittsburgh area, you pay 3% local tax. So that's 60 grand. That would be a deduction versus only 10 grand's a deduction right now. So that's 50 grand ran at a 37% tax bracket.
Significant.
That's 17,100 of tax savings in your pocket. So for high income earners, it's pretty significant. For a low to mid income earner, there's very few differences between the Trump and the Harris plan because you're just not going to reach those higher brackets where it really matters. So I think there is some. And again, not to get into politics here, just to stick to the facts, the Trump tax code is really meant to help higher income, higher net worth, whereas the Kamala is more geared towards taxing higher income earners higher with the proposed of let's even the playing field if possible.
Yeah, and a lot of hers, which we can read off, a lot of hers are tax credits for middle class, lower income earners. So that would Trump's taxes may be slightly lower, but hers would be, you'd get more favorable tax credits would then result in more money in your pocket. So things like she has on here, exempt tip income from taxation, same thing as what Trump proposed. Expand the child tax credit to $6,000 for children under the age of 1, then it phases down. in amount.
I think that one's really good because, I mean, we're in an epidemic right now where we have like not having kids.
Yeah, it's underpopulation problem.
Yeah, and that brings a lot of issues for longevity of a good country, right? So incentivizing from a financial, people are very, financially driven. Incentivizing young couples to start having children, I think, is big, especially those that have student loans, and like seeing the money flow in from this would be a win-win.
Yeah.
So I do like that.
Expand premium tax credits, expand housing tax credits. So that was one. There was I think it was a $25,000 tax credit for first-time home buyers or something like that.
Yeah.
And then increase the Medicare tax.
Ooh, this one hurts.
Yeah, increase the Medicare tax to reach 5% on income above $400,000. So right now, that's this is the net. Oh no, never mind. There was one about the net investment income. This is Medicare tax. So right now it's 1.45 if you're
For you and 1.45 for
so
your employer.
2.9 if you're self-employed, 2.9 total. That would increase to 5 for income above.
Actually, 2.1%. So someone making
$1 million a year.
600 grand times two. I mean, versus the excess now, I think 0.9. It'd be big.
Yeah.
That'd be big. But obviously, they have an agenda of keeping that system, running, the Obamacare as well. So, yeah, very, very interesting. But what's your any further thoughts on how people can prepare for this?
I mean, definitely don't overreact because it's all speculate. Like you said, it has to get passed in the House, the Senate, and the President. So like when Biden got elected, there was a huge tax overhaul that was proposed to do a lot of these things, and it got passed in, I think, the House and not the Senate. So it just never made it through. So there's a lot of steps to even get any of this to pass.
Yeah, absolutely. Well, I think, the big thing is there's obviously agendas on both sides, but just being aware how, again, I think it's really smart to keep politics out of investment policy. I think it's really smart to keep politics out of your financial planning as well. But do be educated on how this impacts your family, right? So if Trump gets elected, here's what my net income is. That's all that matters from a financial planning standpoint. If Kamala gets elected, here's what my take home is, depending on income. And just, I would say educate yourself, because if you're going to take, let's say you're a lower income and you're going to get an extra $500 a month as a result of Kamala's plan. I'm just making these numbers up as an example. Like, make a plan for that, because if you don't, that's $500 a month. Money's a temperature. If you don't educate yourself on that or know, you're just going to end up spending that money. It's just going to go. That's just like the law of financial planning of the universe. Make a plan for that. Start saving that money, because you're obviously current lifestyle now. And then from the opposite side, if you're a high income earner, like you may be missing a couple grand a month. And most high income earners, believe it or not, like in their 30s or 40s, they can't afford to miss a couple grand a month, believe it or not, with student loans, with kids, with everything like that. So just becoming educated and aware how this impacts your financial plan, stress testing it, can be obviously very, very key.
I think this one's really important too. Capital gains and dividends.
Yes.
So it says Trump, no tax policies proposed.
He just wants to keep
no
it the
changes,
same.
Yeah.
Flat, it's a 0% capital gain tax on low income, 15% all the way through mid through high, and then 20. And then there's the Medicare surcharge at 3.8. So you cap out of capital gains right now at 23.8% on a federal level, plus any state that you live in would levy that on top.
So Harris is a significant change. So increase the top tax rate on long-term capital gains to 28% for taxable income over $1 million. So that's an immediate 8% increase. Plus, this one's big, increase the net investment income tax to reach 5% on income above $400,000. So right now, I think that kicks in at $250 for married, somewhere around there. And it's
so you're
3.8.
basically going from 23.8 to 33% now. So it's almost a If you're a $1 million income earner and you have a lot of investments, stocks, real estate at a non-qualified manner, it could be a 10% higher tax.
Yeah,
but almost like a 40% increase in tax, but a factual 10% higher, almost a 10% higher
so
actual tax.
I would say actionable items. I mean, make sure you're maximizing all the tax efficient accounts,
Absolutely.
your Roth accounts, your HSA, your 529, anything that you can get money into. Because I think if you think of like a really easy, outside of estate taxes, a really easy like grab for tax revenue is capital gains and money that's in a taxable account, because that you're paying tax on that much more frequently, and really high income earners and like billionaires, that's where a lot of their money is. So that's the thing that, in my opinion, is like very low, it's low hanging fruit for them to just grab more tax from it. Luckily, they took the unrealized capital gains tax out of this, but actionable advice, just maximize all your tax efficient accounts so you can get as much money out of that environment as possible.
No question. Now, estate and wealth taxes. So if you're, a 1%er, right now you have a record, what is it, 12.93 million?
13, I think it's 12.9. So it's roughly 13.
Well, roughly 13 million that you, and if you're married, your spouse, you each have 13 million, can pass to the next generation, either where you're living or when you die, tax-free. Anything above those numbers gets taxed at 40%. So if you're very high net worth or have the potential to get there, 2026, this expires, so it gets cut in half, back to the 6 with inflation adjustments, probably around 7 each. So that's a big cut. And so, let's say someone's worth 50 million that dies, like both spouses die. If they die this year, basically 26 million, if they're married, goes tax-free. 24 million gets hit at 40% tax rate from a federal level. So that would be 9.6 million, right? 26 times 40%.
13, but like 11.
10.4 million.
Yeah.
10.4 million of tax. Literally 10.4 of your 50 handed to the government, right? But if you die 2 years from now, under just currently have no policy law changes, it's 14's tax-free, 36 gets taxed times 40%.
16 million-ish?
Give me 1 sec. 36. Right? 14.4.
Yeah.
So that's an extra 4 million.
In tax, yeah.
So obviously you can do, 14.4 million, just double checking my math there. But that's a $4 million, basically a $4 million tax hit if you're very rich. So there's many ways to save that. You can gift the money now. You can set up a trust, a spousal life access trust, a family limited partnership if you want to maintain control of your business interest. Shift some of that to the kids. Well, you have the 13 million, not the approximately 7 million that we're anticipating in 2026. So, Trump has come out and said, I want to make those limits permanent. And Kamala, I think, she's got some big donors, some big backers. So she's doing a good job of I think reaching both sides right now, because she's changed a lot.
Yeah, she pulled off the capital gains one had to get
35 down to 28.
Because like people that were backing her got mad that.
Yeah. And so I think you're going to see, I'm not sure, because Bernie was pushing hard for 3.5.
I read somewhere that there were even talks they were trying to get it down to 1 million.
Like it was over a decade ago.
Bottom line, 13's really high, and it probably.
Yeah. So we would anticipate that Kamala's going to come out with a lower number, or just keep the current policy in place when it gets cut.
Yeah.
Which would be the easy thing to do, so she could focus on, more pressing issues. But this is obviously a big revenue generator for the government.
Yeah.
So any other closing thoughts? Those are the ones. There's lots of little things that 99% of people would not have to worry about, such as that a lot of this stuff is going to more deal with how our foreign relationships are, how the stock market is able to perform, what companies are set up for the stock market. But we obviously have done several podcasts on the portfolio, but this one we want to focus on how this affects you as an individual, which if you're an individual, you're probably investing in the stock market. That could get affected with corporate tax rates, and then ultimately what your paycheck ends up in your pocket. Yeah. And then if you're doing estate planning. So
yeah, I guess bottom line is just stay aware of it. And we have seen they could retroactively for the year that a law gets passed. So if either one of them gets elected and something gets passed in June of 2025, they could say all of 2025, because nobody's filed their taxes yet, is going to be under new tax code. So that's one thing to be aware of. Just try to be proactive about it. And if, obviously we're going to be aware of this and communicate this to clients. If there's something that's going to change, we'll be proactive about planning to try to mitigate some of the taxes as best we can.
Absolutely. Well, Jameson, thanks for joining, and thanks for joining us, everybody. We look forward to catching you next week. Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.